All right, Tyler, there's a high yield dividend stock that you and I have both followed for a long time. I actually own a little bit of, and I had a friend reach out to me actually in the past 24 hours of us recording this video, completely independently of you coming to me and saying, hey, let's do a video talking about NextEra Energy Partners, asking me, hey, this stock's down. Is it a buy right now? So guess what? We're going to do a video talking about this exact same thing. Is NextEra Energy Partners stock down 30%? Is it a stock to buy on the dip? I'm Jason Hall. This is The Smattering. Tyler's here with me, Tyler Crow. Before we talk about NextEra Energy Partners and whether it's a buy on the dip stock or not, The Motley Fool is our sponsor for these videos. If you're looking for even more great stock ideas than the one we're going to talk about right here, go to our special link, fool.com/The Smattering. The Fool's got 10 great stock ideas for you. It's 10 best stocks to buy right now. Go to that link after this video and check it out. Again, fool.com/The Smattering. It's right there on your screen. You can't miss it. It's right there. All right, Tyler, let's talk about NextEra Energy Partners. Before we get into whether or not we think it's worth buying right now, what is NextEra Energy Partners? Why does it exist?
To sound fancy, it's a specialty finance vehicle, is kind of a way of describing what NextEra Energy Partners is. It was spun out of NextEra Energy, and they have used it as a way to own solar projects, mostly solar, I think, is the vast majority of what it has.
There's also a little bit of natural gas and natural gas transportation in there too. Yeah.
Yeah. The core idea is that it's built to own assets that NextEra Energy owns, but aren't regulated utility assets. So it uses NextEra Energy Partners as a way to help bolster the finances of it. We're going to
I want to break that down real quick for investors. So NextEra Energy, its biggest subsidiary is Florida Gas and Light, right? So it's regulated utility that sells power to businesses and to residential customers. It's regulated by the state of Florida. It's control the rates that it can charge and that kind of stuff. NextEra Energy also has this unregulated business which produces power and a few other things like the gas and that kind of thing, but it sells mainly to other utilities, right? They need power, they're buying it, and then they use it in their regulated businesses, or they might sell it to large industrial users that then have. So that's when we say regulated utility versus unregulated, that's the difference. Who are you selling the power to? So
exactly,
as you were, Tyler.
So all these things are sold down, and it's basically to own the assets. It's a kind of a way of lightening the balance sheet, I guess you will, of NextEra Energy.
Yeah, you control the assets because NextEra Energy is still the controlling entity for NextEra Energy Partners, but it doesn't have to own those assets and then own the debt liabilities too. Just pushes them down, right? Drops them down to NextEra Energy Partners.
Other investors come in and they get a cut of the cash flows in addition to what NextEra Energy takes as a majority owner of those shares. Here's where things start to get a little more complicated. It's been a good growth story for quite some time. Distributions have been going up for a long time. It had a decent yield somewhere in the 4%, maybe 5% range for quite a long time. And NextEra Energy just kept throwing assets to it, more assets. And the idea was, as long as financing was cheap, as long as it could access cheap capital, either in the form of cheap debt or in the form of a high price stock that didn't have to pay out a huge yield on its stock, it made a lot of sense. It could grow really quickly. Well, with the stock down, the financing becomes more challenging. If NextEra Energy Partners wants to buy assets from the parent company, NextEra Energy, it has to issue shares, right? And if it issues shares, it can do
one of two ways. It can issue shares to raise cash, or take on debt to raise cash.
Right. When you have those three choices, you can do debt, but eventually you can only give out so much debt because there's interest payments involved, and people don't like very leveraged companies. It gets scary, right? You can issue equity, or like you said, cash. And the equity is appealing when the dividend yield is low, because
that means the stock is high, and that means your cost of capital is lower versus issuing debt.
Yeah. Think of it like, if you think of the equity like debt, because you have to pay out a regular dividend distribution, the dividend yield, whatever you want to call it, when it's high, that means the cost of capital is higher. It means every incremental dollar that I raise has to go out the door in financing. So as the stock price declines, the yield goes up, and that makes it more expensive to buy things. And when it's more expensive to buy things, not every deal is as attractive, because if the returns for a business is 7%, When I can issue equity that yields 4%, that's okay. 3%, that's
You can
the,
make money, right?
but if I have a 7% returning project and I'm issuing equity that has a 6.8% yield, 0.2% doesn't get it done,
You're
right?
not making any money. And
Exactly.
it doesn't make sense. If you're NextEra Energy, you're losing the cash flow that it was generating by holding the asset by pushing it down to the subsidiaries.
When this starts to happen, it's not great for investors. Even though the stock is down, yes, the yield looks nice. The business itself requires a lower yield to be very attractive from a growth standpoint.
For a lot of investors can sound really counterintuitive because the thesis for owning it is that it's going to pay a good yield and they should be able to grow because it's renewable energy and there's growth there. So they should be able to grow the payouts. So it is counterintuitive that when maybe it feels like it should be really appealing, there is that other side of the risk curve for the cost of capital thing that investors really need to be cognizant of.
For that reason, I'm not wholly on board with the idea that it's a screaming buy right now or buy on the dip. This could alter how NextEra Energy treats NextEra Energy Partners.
Historically, this has been a pretty good partnership. It's been around since 2015. I think it certainly benefited greatly from the low interest rate environment that we saw. It was a market beating stock until, I don't know, end of 2021, right? In mid 2022, we started to see interest rates come up. And over the past year and a half or so, the stock has really come down. But I do think that investors are willing to take a conservative approach, acquire a little bit, not buying it because you see that high yield today and you're like, hey, I can lock that in. There's no promise to that dividend. There is definitely the potential that if the environment continues to remain high interest, the stock price stays down, cost of capital is high everywhere, the management says, well, we have to cut the dividend because we've got to do some things to free up our cost of capital to issue more stock to do more of these drop downs. If you can navigate through that potential risk, I think it's still relatively appealing because even if we see a situation where NextEra Energy says, you know what, we're going to consolidate this back and we're going to roll it up, I think there's a chance if you're willing to maybe dollar cost average into this business, you're going to be okay probably as an investor. You're going to earn a little bit of yield along the way. But I think you have to be careful until we get more certainty, like Tyler says, until we hear from management and get some really clear idea of what their intentions are, that this is not a stock that I don't think you can expect it just to double and you're going to capture this big yield too. Just got to be careful, investors.